Hello and welcome to another video of fundamental analysis. In today's video, I am analyzing GAIL India Ltd, GAIL. Incorporated in 1984, GAIL has over the years evolved as an integrated natural gas company with a presence in transmission, gas processing and downstream petrochemical products, which uses natural gas as the primary input. GAIL also has interests in liquefied natural gas LNG business through Petronet LNG Ltd, Ratnagiri Power Projects, and in city gas distribution projects both in India with Mahanagar Gas Ltd and Indraprastha Gas Ltd, and overseas with Natgas and Fayum Gas in Egypt. Among these projects, GAIL's most significant interest lies in the Petronet LNG and Ratnagiri Power Projects. In Petronet LNG, GAIL, apart from being an equity investor and the major transmitter of gas, has also undertaken to market 60% of the regasified LNG through a 25-year take or pay contract from Dahej terminal and 30% of the volumes from the Kochi terminal of Petronet LNG. The take and pay contract means if they don't collect the gas from the plant, then they have to pay a certain amount to the supplier. So this protects both the supplier as well as the buyer from market fluctuations. GAIL now controls the Dahej LNG terminal through Konkan LNG Private Limited. Post the demerger of Ratnagiri Gas and Power Private Limited, its assets and liabilities related to the LNG terminal were transferred to KLPL, that is Konkan LNG Private Limited, which was approved in February 2018. GAIL also has stakes in exploration and production of hydrocarbons. Basically, hydrocarbons are the chief or the main components of petroleum and natural gas. GAIL has wholly owned subsidiaries in Singapore and the US for expanding its presence outside India in the segments of LNG, petrochemical trading and shale gas assets. GAIL has leadership in natural gas transmission and the sector is characterized by high entry barriers. GAIL enjoys a dominant position in the natural gas transmission business with a market share of approximately 70%, catered to by its large pipeline networks covering 12,200 kilometers approximately. The setting up of pipelines requires large investments and navigating a complex regulatory framework. As a result, the entry barriers to the natural gas transmission business remains high. Dominant market share in transmission segment along with regulated returns on the capital employed results in healthy profitability and stable cash generation for GAIL. The return on capital employed for the gas transmission division moderated from 26% in 2011 to around 9% in 2016 due to lower tariffs. Regulators have revised transmission tariffs for several pipelines in the last couple of years, providing an uplift to the return indicators for the transmission segment, which improved to 11.9% and 12.1% in FY 2019 and 9-month ending FY 2020. Government's focus on increasing the share of natural gas in the overall energy mix of the country to 15% from 6.5% currently has resulted in the government taking several steps to increase natural gas consumption. As domestic gas production has been on a downtrend since FY 2013 with marginal growth witnessed in FY 2019, the reliance on imported LNG has been on the rise. The increase in regasified LNG consumption can be attributed to the significant decline in the R-LNG prices during the last couple of years and the implementation of gas pooling mechanisms in the fertilizer sector. The demand for natural gas is expected to remain healthy, driven by the city gas distribution, and the fertilizer sector. In order to diversify its revenue streams and utilize its ability to source natural gas efficiently, GAIL has also diversified into downstream sectors, that is manufacturing of petrochemicals and LPG gas. The LPG segment has been aiding profitability of GAIL and maintaining healthy segmental contribution. The petrochemical segment's profitability has fluctuated over the years owing to the volatility in the polymer realizations and raw material prices. Polymer is a molecule which is broken up to produce different petrochemical products. GAIL's financial risk profile is characterized by healthy profitability and strong cash accruals, resulting in comfortable debt metrics and capital structure. The profitability has seen some moderation in 9-month ending 2020, driven by moderation in the performance across the segments. The overall financial risk profile, though, continues to remain robust. The net profit moderated to around 3,600 crores in 9-month ending 2020 as against 4,903 crores in 9-month 2019. The debt level vis-a-vis operating profit and the net worth continues to remain low. The gearing ratio of the company, that is total debt compared with the operating profit before depreciation, interest, tax, remained low at 0.1 times at the end of first half FY 2020 and remain unchanged from the levels of FY 2019. Interest coverage ratio of the company remained robust at 78 times till December 2020 as against 70.3 and 69 times in December 2019 and the entire fiscal year of 2019. GAIL enjoys exceptional financial flexibility given the stable cash accruals, strategic importance to government, and long relationships with the investors and the capital markets. The company can access the capital markets at short notice to raise funds and also finds favor with the lending community for raising loans at attractive rates. In December 2011, GAIL signed an agreement to import 3.5 MMTPA of LNG from Schneider Energy's Sabine Pass liquefaction plant in the US for a period of 20 years. GAIL has another 2.3 MMTPA contract to liquefy gas at Cove Point Terminal in the US. The pricing formula for these contracts is linked to the HH, which is Henry Hub Natural Gas Index, which is the benchmark natural gas price in the US. In recent years, the Henry Hub prices have remained range bound between 2.5 to 3.5 per MMBTU per dollar. As a result of the pricing formula, the HH based LNG is costlier, which puts it in a significantly uncompetitive position as compared to spot LNG and other crude oil price linked LNG contracts in a scenario of low Brent crude prices. To explain this, understand that GAIL has a contract to import a certain quantity of LNG from the Henry Hub terminal of US. Now the prices that they have already agreed to in that contract, compared to that price, the Brent crude prices are lower. Even the other crude oil prices are lower than the HH based index prices, and therefore it puts GAIL in an uncompetitive position. In a sustained low crude oil price scenario, GAIL may face profitability pressure on the marketing HH linked LNG. So as I mentioned, the company currently imports LNG from the HH terminal, that is Henry Hub terminal in the US, and their prices are quite higher than the Brent crude prices, and therefore it creates a kind of a profitability pressure on the company. The company has taken remedial measures to ensure offtake of the gas being procured from the US through destination swaps and commodity hedging, which should enable the company to avoid material losses on the LNG being procured from the US. Now, to mitigate this problem of contract that GAIL has entered with HH Terminal to procure LNG, the company has done commodity hedging and has gone through destination swaps. These are the measures, hedging measures, that the company has taken to avoid substantial losses from their procurement of LNG through US. In the current scenario, the Brent crude prices have witnessed a steep decline and the competitiveness of the HH indexed LNG has come under pressure vis-a-vis Brent index LNG. Going forward, the relative competitiveness of the Brent indexed and HH indexed LNG will remain a key monitorable. So this will need to be kept into consideration, because right now the prices at the HH indexed and the prices at the Brent are having a big difference between the two of them. The tariffs approved by the PNGRB, which is the Petroleum and Natural Gas Regulatory Board for India, have been lower than the provisional tariffs proposed by GAIL. However, the recent significant upscaling of tariffs for several pipelines indicates a more benign regulatory regime, which should lead to higher tariffs for the remaining pipelines. The new pipeline projects being undertaken have been allocated on the basis of competitive bidding, due to which the returns on the new projects are expected to be lower, resulting in overall lower returns from the transmission segment. Petrochemical, LPG and LHC, which is the liquid hydrocarbon segment, are exposed to the commodity price risk, as sustained low crude oil prices result in low realization for the petroleum products. So the low crude oil prices are in direct competition with the petrochemical, LPG and LHC segment of GAIL. As was visible in December 2020, petrochemical segment witnessed significant decline in its profitability, driven by low polymer margins. The liquidity of GAIL is strong given the healthy cash accruals, unutilized fund-based limits, and the ability to access capital markets at a highly competitive rates. The internal cash generation is expected to be more than adequate to meet the near-term debt repayments and margin funding for the capex program. Negative triggers include materially large debt-funded capex or acquisition resulting in deterioration in the credit profile, and it will also have a negative impact on profitability owing to fall in the transmission volumes owing to the COVID-19 lockdown and material loss on sale of US LNG. Natural gas is generally extracted from faraway places from human habitated area. To transport this natural gas in gaseous form is costly, hence it will be converted to liquid form by cooling down to -162 degrees Celsius, hence the name liquefied natural gas. Main advantage in this conversion is natural gas in liquid form is 600 times less in volume than in gaseous form. Before distribution, this LNG will be converted back to gaseous form through the regasification process, R-LNG. The last 2 points I'm explaining what is R-LNG and what is LNG and how it is transported. So this concludes my analysis of the company's profile. Let's move on and look at the company's financial statements, including the annual profit and loss account, balance sheet, cash flow statement, as well as the quarterly profit and loss account. From there on, we will look at the peer group comparison and we'll check out where the prices of this company is in terms of technical analysis, and finally we'll look at the intrinsic value calculation and where we can buy based on fundamentals as well as technicals. Let's begin our analysis of the financial statements of GAIL India Ltd. Beginning with the profit and loss account analysis. Before I begin, let me point out a few things about this analysis that I am doing in every video. The sole purpose of making these videos is to educate investors in investing their hard-earned money wisely by learning and educating themselves and then investing. The learning stage involves understanding the profile of the company, understanding the financial statements, all the numbers, the ratios. The ratios are used by comparing different statements and finding out the profitability ratio, the liquidity ratio, the cash flow statement analysis. And there is a lot of work an investor needs to do before he decides on in which company he wants to put his money into. If you ask me after looking at the entire video in which company I should invest, I'm sorry, you've not understood the whole concept of me making this video. The sole purpose of making these videos are to educate you. That is my assumption, that I'll be educating you, and you not asking me, you would make your own decision based on your understanding as to whether this company is good or not good for investment. How you will decide whether you want to invest in this company depends on how much time and effort you put into watching this video. I don't want you to watch because I want more watch time for my videos. It is just that if you don't devote at least 1 hour of yours into understanding how the company is functioning, how efficiently it is managing its resources. Efficient management of resources would include inventory holding, the sales to debtors ratio, and many more things, growth in sales, that will show efficiency of the management. Through these quantitative analysis, that is analyzing different statements, our aim is to get the understanding of how the health of the company is. So let me begin my analysis of the profit and loss account, beginning with the growth in sales over a period of last 5 years, 3 years, and the latest growth over the March 19 values. We've seen a fall in the revenue generated through sales of around 3% from March 19. In March 19, the total revenue was around 75,000 crores from its sales, whereas in the recent 12 months it has decreased marginally to 72,000 crores. But in the 5-year and 3-year growth trend, that is from March 14 to March 19 and March 16 to March 19, we have seen a positive growth rate in the sales. This is the compounded growth, that is every year the sales have been compounding since last 5 years at the rate of 5.5%, that is from 57,000 crores to 75,000 crores. And in the last 3 years the growth is at the rate of 13%, from 51,000 crores to 75,000 crores. Average operating profit margin over the 5 and 3 years average has been below 15, which is my benchmark. Let us look at the individual values of March 19 and the recent 12 months. In March 19, the operating profit margin was around 12.7, and in the recent 12 month it has dropped to around 10.4. So there is a profitability margin pressure on the company. The sales have dropped marginally. All these ratios are important, or through which I can gauge the health of the company. Other income is contributing around 1,400 crores in the recent 12 months, which is occupying just 2% of the total sales. And if we see, the value has been quite flat in percentage terms. Other income can be used to manipulate the profits. If the company is consistently showing higher other income against the sales done, then that can create a misleading figure in terms of net profit. If the value of other income is very high, that creates a red flag. Moving on to the depreciation percentage, we can see a very flat percentage of depreciation deducted every year from the P&L account. Of the total sales, the depreciation value in the recent 12 months was just 1,700. So we see a very flat trend here, which again signifies to us that the company's assets have stabilized and their capital expenditure have also stabilized. In terms of how much amount is being depreciated every year, it's increasing gradually, but percentage wise it is very stable and flat. So in analyzing each ratio, my purpose is to see if I can find red flags or potential problems which then can help me avoid investing in this company. Raw material cost percentage has been always very high. Above 75% of the revenue that the company is generating is going in the operating expenses towards raw material. Raw material in March 19 occupied almost 78.8% of the sales, a very high value. But because this company is into production, distribution of LNG and other petroleum products, its raw material expenses would be very high. And we have to look at the trend of how the raw material cost has been throughout the years. Employee cost percentage has been steadily rising, but still a very good value considering the amount of sales it is doing. Interest expense percentage of the company against the total sales is very minuscule and small. In the recent 12 months, just 102 crores went towards finance cost out of the total sales of 72,000 crores. A very small amount, and if you look at the trend, it is a downward trend, and the company is almost debt free, because this interest cost or finance cost signifies how much debt the company has taken, and if the company's debts are high, then the interest cost would also be high. And here the downward trend signifies that the company is becoming almost debt free. Company's tax rate structure is also very important to understand, because that can inflate or deflate profits. If the company is manipulating or deferring or extending its tax liability, the amount of tax it has to pay, if it is getting deferred every year for whatsoever reason, then that means the company is manipulating its accounts, and we don't want to see that. So we have to look at this trend also. You would wonder why I am analyzing tax rate structure. This is the reason for that. If you look at March 19 and the recent 12 months, the percentage rate is exactly the same. The amount of PBT has decreased. The amount going towards tax expenses have also decreased proportionately. In March 16, the value of tax paid was around 27.3%, not far away from March 19 values. Interest coverage ratio, we have already seen in the company profile that this company's coverage ratios have been high throughout the years. In the recent 12 months, the multiple was 70.9 times, which signifies that the earnings before interest and tax, which is the top line profit, is 70 times higher than how much interest or finance cost it is paying. Even March 19 values were high at 66.6 times. The amount of EBIT has fallen from 9,200 crores to 7,200 in the recent 12 months. Although if you look from 3 years back, the amount of profit it generated has increased exponentially from 3,800 to 9,200 in the 3 years. The multiple was quite low in March 16, and the amount of interest it paid against the EBIT in March 16 was also at a multiple of 4.8 times. Net profit margin has seen a wide variations in terms of percentage. If you look in the recent 12 months, 6.5% of NPM on a total sales of 72,000 crores, the company generated around 4,725 crores of net profit. One thing I would like to bring to your notice is that this analysis that I'm doing is of standalone statement, because this company does not have a substantial contribution from its subsidiaries. I have considered the standalone values for this analysis as well as for the company profile. In March 19, NPM margin was 8%. On the total sales of 75,000 crores, the profit earned was 6,000, and that profit has now decreased to 4,700 crores. In March 16, the value was even lower at 4.3%. So that is why I mentioned that the net profit margin values has seen a lot of variation over the years. Let us look at the average NPM. That will give us a kind of stability. In the last 3 years, NPM margin was around 8% on average basis, and in the last 5 years at 6.7%. The recent NPM of the 12 months has fallen below both its averages, and that shows a sign of weakness in terms of margin. Looking at the net growth in profits compounded over last 5 years, 3 years, and in the recent 12 months, the profits have seen a degrowth of around 21.6% from March 19. That is a fall from 6,000 to 4,000 crores. Whereas a long-term trend has seen a positive growth. In last 5 years, the net profit has grown at 6.6% compounded, and in 3 years at the rate of 40%, from 2,200 crores to 6,000 crores. Now, one thing to keep in mind is that from 14 to 16, the profits have fallen. So we don't take this value here, or we don't consider this value as 40%. Instead, we look at the 5 years value for our analysis, and we consider this as the growth rate even for 3 years, because March 14 the company had earned 4,300 crores, and from there, if you look, the growth was at the rate of 6.6%. So just because the company is showing 40% growth rate does not mean it is good. It just means that the base year value was low, and therefore the percentage wise showing a higher value. So overall, the company's net profit has seen a pressure in the recent 12 months. Market cap to sales ratio was always trading at a discount. The sales throughout the years have always been higher than what it was valued in the market. In the recent 12 months, the company's market cap was approximately around 20,000 crores against the total sales done of around 72,000. And we see a flat trend in its multiple over the years. The company's sales have always been higher than what it was valued in the market. By March 19, the total company value in the market was 39,000 crores, which has now dropped by almost 10,000 crores to 19,788 crores. Dividend payout has always been about 25%, at least for the years that we have on the screen. In March 19, company paid out 1,600 crores as dividend out of its total profits earned of 6,026 crores. Even back March 16 and March 14, we see a high percentage of dividend payout. The current price earning multiple is at 8.4 times. The earnings per share has declined from 26.7 rupees per share to 10 rupee 50 paise per share, and even lower than the March 16 value of 12 rupee 20 paise. The price earning multiple is at 8.4 times. This is a good multiple, but we'll need to look at the peer group companies where those companies are trading at. But if you look at the trend of the price earning over last 5 and 3 years, we see that the company was trading at a multiple of above 7.5 times, but the recent multiple is even higher than that at 8.4. We'll need to wait for the price to fall further so that it comes below the 5 and 3 years average price earning. The price in March 19 was 174 rupees, and that has now dropped to 88 rupees. Along with the drop in price, the earnings per share has also dropped, because here the price is falling and the company's EPS is also dropping, and that creates a double whammy for us, because we are not getting a good valuation when both of them drop. A good valuation comes when the EPS is going up and the price is falling for whatsoever reason. Moving on to the balance sheet analysis, equity share capital has doubled from March 16 to March 19. The face value is flat at 10 rupees per share. Return on equity of March 19 was around 13.7%. The total shareholders contribution into the business was around 44,000 crores, and against that the net profit generated was around 6,000. That translates to roughly around 13.7% and higher than the March 16 value of 6.3%. If we look at the averages of long term of 7, 5 and 3 years, we see that it has generated above 10% of ROE, and the current ROE of March 19 is above its averages. Although I would want the return on equity percentage to be above 15, which is my benchmark, but we will need to compare it with its peer group companies. Checking out the return on capital employed, this looks at how much source of funding the company had, the total funds the company had employed into the business, and against that how much EBIT or top line profit it generated in that particular year. In March 19, the ROCE percentage works out to around 20 on the 45,000 crores of total capital the company had, including the equity shareholders contribution as well as any and all borrowings. Company's EBIT was around 9,200 crores. And if you look at the trend over March 14, it has increased substantially. In March 16, we see a pressure on the company's return ratios in terms of ROE and ROCE. Looking at the averages of 7, 5 and 3 years, we see it was always quoting at somewhere slightly above 14%, and the recent ROCE of 2019 is above all its averages. Return on total assets stood at around 9.1% and almost at March 14 and slightly above March 14 value. So on the total balance sheet size of around 66,400 crores, the company had earned a net profit of 6,000. If you look at the debt to equity ratio, the company has become almost debt free in March 19. If you look at the previous values, the debt is showing a gradual decrease over the years from 10,200 crores in March 14 to 1,000 crores in March 19. So the company is paying off its debt. The company's equity in the business has been growing steadily from 14 to 19 and the debt is coming down. So that's a very good sign. And if we look at something like this, then it gives us confidence that the company's management is managing the business efficiently. Equity is contributing around 66% to the total liability, or we can say to the total assets or to the total balance sheet size. Whereas in March 19, the debt contributed just 2% of the total borrowings or total assets. The company's price to book ratio was always trading at a discount to its net worth. In the recent 12 months, the company's market value was around 19,700 crore. Against that, the company's equity shareholders contribution in the business or net worth was 44,000 crores. That's a high discount of 0.4 times. Even throughout 16 and 19, it was always trading at a discount to its net worth. Looking at the debt to net profit ratio, this would again be very small, and it has been dropping. As we saw, the debt was reducing. So the total borrowings in March 14 was around 10,200, which decreased to 8,000 in March 16, and in March 19 it is now just 1,000 crores. Against this 1,000 crores in March 19, the company's profits were around 6,000. So it can very easily pay off, if it wants to, this particular debt and become a debt-free company. And in terms of percentage terms, the debt is occupying just 17% of the total profits. Previously in March 16 and March 14, we saw the debt was around 3.62 times higher, whereas in March 14 it was 2.35 times higher. So here too it was very comfortable position. So it would take the company simply 2.3 years to pay off this debt. Next, let us look at the net block percentage. That is, how much was the fixed assets compared to the total balance sheet size. The company has an heavy investments in fixed assets, and the trend in investments in the assets of fixed nature has been increasing constantly over the years. As of March 19, the total assets of the company stood at around 30,415 crores. On that, the total balance sheet size was 66,000 crores. Now, if the fixed assets is occupying such a high percentage of the total balance sheet size, how come the depreciation value that is being charged to the P&L account is so low? That needs to be investigated. So let us quickly calculate what is the percentage of the net block that is going to the P&L account as depreciation in 2019. So here I have the depreciation percentage from the P&L account. The company had depreciated around 1,550 crores to the P&L account in March 19. So let us calculate how much percentage that is of the total fixed assets. The fixed assets were somewhere around 30,000 crores. So that translates to around 5.16% depreciation rate being charged in March 19. This seems reasonable because the amount of fixed assets the company has would be of a long duration. That is, its lifespan would be of 20 to 30 years. Therefore, it can depreciate those assets at a lower value than depreciating it much faster to the P&L account. And that is why we'll have to look at the trend or percentage of every year how much it is depreciating its fixed assets at. That is why I say that even looking at the depreciation percentage is very important in the analysis. Moving on to the capital work in progress, around 13% of the total balance sheet size was under capital work in progress, meaning 9,200 crores of work of capital nature was going on in the business as of March 19 out of the total assets of 66,000. So this assets, as and when gets ready or completes, that will be moved to the net block. So the net block will increase and the capital work in progress will decrease accordingly. Company's investment percentage is at around 14.3% of the total asset. Value wise, the amount of investments holding is increasing from 14 to 19. Currently it stands at around 9,500 crores of the total balance sheet size, which translates to roughly 14.3%. So this is a okay percentage. We don't want it to exceed 20% of the total balance sheet size. In terms of debtors percentage, around 6.1% of the total balance sheet was occupied by debtors from whom the company still had to collect payment. So it is around 4,060 crores of pending payments, which is a small percentage. We don't want this to exceed 30% of the total balance sheet size. And if you look at the trend over the years, it has been at a very steady percentage rate, although currently in March 19 it has moved up to 6.1%. Next, let us look at the debtors turnover percentage, that is what portion of the sales was occupied by debtors, or how much payment was pending to be collected from the customers against the sales of 2019, which is a very small percentage, just 5%, and we see a very flat and stable percentage rate of 5%. So the company's sales have increased from 57,000 crores to 75,000 crores, and accordingly the customers from whom the company has to collect payment have also increased proportionately, and therefore the company has managed to keep its debtors turnover percentage at a fixed level. Debtor days is the days that the company takes to collect payment from its customers. It has been increasing by 1 day between every 3 years gap from 14 to 19, and even this collection days is okay because I don't want it to exceed 90. But when we look at the peer group comparison, we'll see how many days or within how many days other companies are collecting payment from their customers and what is their sales to debtors percentage. Company's cash holding was at 2% of the total assets. In March 19, company's cash holdings were just 1,200 crores and it has been declining steadily over the years. Company's current ratio of 2019 stood at 0.8 times. Its liabilities have increased more than their current asset holding. Therefore, it will have to resort to borrowings or make arrangements from its internal resources to fill up this gap of around 4 or 5,000 crores. The current ratio stood at 0.8 times and it has decreased from where it was in 14 and 12, from where it was in March 14 and March 16. Company's inventory holding percentage was at 3.5% in March 19. a small amount compared to the total assets, and this is a good value. We can see a stable percentage rate throughout the years. In terms of how much inventory it is holding against the sales, the multiple stood at around 32 times. So if you look at the trend, it has always been about 25 times. So the company, the more the inventory turnover, the better it is. It means that the company is increasing its sales against its inventory holding. Moving on to the cash flow statement analysis. Here we want the company's cash inflows from operating activity to be more than the net profit. In March 19, the company's cash inflows were 31% higher than the profit declared. In March 19, the company declared a profit of 6,000 crores. Against that, it received 7,800 crores from its operating activity. In March 16, the cash inflows were 83% higher than the profit, whereas in March 14, it was 12%. So over the years, we can see company has been receiving higher cash than the profits it declares. If you look at the trends of 3, 5 and 7 years, in last 3 years, the cash inflows were 58% higher from operating activity compared to the net profit. In 5 years, it was 48% and 7 years 39%. Over the long term trend, also we see higher cash inflows than the profit declared. And this is how I want the company's cash flow from operating activity to be. In March 19, the company's total cash inflows from operating activity was 7,800 crores. Against that, it invested 69% into investing activity, that is 5,400 crores were transferred into investing activity. This investing activity would include buying of assets for the company and investments in mutual funds, shares, etc. And if we look at the other two data that we have of March 14 and March 16, it is also within a comfortable position. Looking at the long-term trend of 3, 5 and 7 years, it has never exceeded 50% over these years clubbed together. So in the last 3 years, company had earned a cash of 22,300 crores. Of that, it invested, or it put 8,385 crores net into investing activity. In 5-year trend, it was 35% of the cash earned, and in 7 years 48% was invested or put into investing activity. Let's look at how the price has changed from where it was in March 16, that is 3 years back, March 14, 5 years back, and March 12, 7 years back. I have both the CAGR growth rate, CAGR growth rate of every year drop or gain, as well as total drop from 3, 5 and 7 years back. Looking at the March 16, it was around 100 rupees per share, and the current price stands at around 87. And the drop every year from 16 to the current market price was around at the rate of 4.3%, and the total drop is around 12.5%. So we are getting it at a rate which was below March 16 value. If we look from March 14, the drop is at around 17%, and every year the prices have dropped at the rate of 3.7% compounded. So here too we are getting it at a discount to March 14 value. Moving on to the March 12 value, here too the price was very similar at 105.8, and the CAGR drop rate was around 2.6% since 7 years, and total drop of around 17.1%. So we are getting it at a discount, that is the current market price is available at discount to where it was 7 years back. Let's recap the valuation ratios. Price to earnings at 8.4, a good value, but we'll have to look at where the other peer group companies are trading, as well as we'll have to look at the PEG ratio, that is price earning to profit growth ratio comparison. Price to cash at 2.5, a very good value. It should be below the price to earnings. So we are getting it at a great discount to even price to earnings. Price to book again at a discount of 0.4 to its net worth. Market cap to sales also at a discount of 0.3, sales being higher than the market price given to this company. Moving on to the quarterly P&L account analysis, sales over both year on year as well as quarter on quarter has seen a fall. YOY around 10.2% fall from 19,700 to 17,700 crores, whereas quarter on quarter around 1.5% drop from September 19 to December 19. In terms of profit growth, YOY there was a 25% degrowth, quarter on quarter 17.5% growth. December 18 total profit declared was around 1,600 crores against December 19's 1,251 crores, whereas from September it was even lower at 1,000 crores, and that has gained. So this value would not count because overall we want to see an upward trend. So if in December 18 it had earned 1,600, we expect that in September 19 it should have earned much higher than 1,681 crores, and December 19 it should have been further up. So we have to assume that the fall itself is 25.6% and not a growth of 17.5 quarter on quarter. This would not make sense because after falling, if it rises, that is not countable. Finally, let's look at the net profit margin. Over the three quarter data that we have of December 18, September 19 and December 19, it has always been below 10% throughout. December 18 8.5%, September 19 5.9 and December 19 7%. In December 19 total profit earned was around 1,250 crores and on a total sales of 17,700 crores. So not only has the sales fallen from 19,700 to 17,700, but the profit has also seen some pressure. So this concludes my analysis of the financial statements of GAIL India. Let's move on and look at the peer group comparison. In the peer group analysis, I am analyzing GAIL with Petronet and Indraprastha Gas. The current market price of GAIL is 87, Petronet at 224 and Indraprastha at 458. The results are up to date till December 2019. Let us begin by analyzing the quarterly sales growth YOY. GAIL has seen a degrowth of around 10% in its overall sales from December 18 to December 19, whereas Petronet has seen a fall of around 11%. Indraprastha has seen a 10% growth in its sales. We do this analysis to understand how GAIL India compares with its peer group companies. Quarterly profit has seen a degrowth for GAIL at 25%. But in Petronet and Indraprastha, we see a positive double-digit growth. In terms of sales for the entire 12 months, compared with 2019 sales value, GAIL has seen a fall in its overall revenue generated for the entire year. A negligible fall, but almost near to 2019 values. Even Petronet has seen a fall in its revenue from 38,000 in 2019 to 35,000 in the recent 12 months. Indraprastha has seen a growth from 5,700 to 6,400 crores in its revenue. But when we look at the values that these companies are generating, GAIL is way ahead in terms of sales volume than the other two companies. So we can estimate the size of this company should be more than double of Petronet. Let us look at the profits of the recent 12 months and compare it with 2019. GAIL has also seen a degrowth in its profits from the recent 2019 values. 6,200 was the value of profits earned in 2019 compared with 5,000 crores, almost a 1,000 crore of fall in its profits in the recent 12 months. Compare that with the Petronet and we see a slight rise from 2,100 to 2,800 crores in its profits of the recent 12 months. Even Indraprastha has seen a growth from 740 to 1,100. Only GAIL India has seen a substantial drop in its 12 months profit values. Next, let us compare the profits of 2019 and against that profit how much cash has flown from operating activity or received or given out of the operating activity. GAIL total profit declared was 6,200 and the amount of cash coming in was higher at 7,800, so this is a good value. Petronet's profits and cash flows are almost very nearby to each other. Indraprastha also has received a higher cash against its profits. So almost all the three companies in terms of cash flows is doing good, at least in 2019. We'll also have to look at the 5 years profit value and compare that with the cash flow from operations. And if someone wants to go one step ahead, then they can even look at the 7 years of profits and cash flow comparison. Highest fall in price from 1 year is seen in GAIL at 51% drop from its 52-week highest point reached. Petronet has seen 25% and Indraprastha has seen 14%. So the lower it falls, the more strength it is considered that stock has. GAIL's latest price earning is 7 times, Petronet at 11 and Indraprastha at 28. Here it is above my benchmark, and if you look at the 5 years average, it was 24 and 19 times. So it is still above its average. Although this can be considered as a strength because the company's price is trading at a premium to its earnings. But when we want to buy into this company, we have to wait for it to come to our benchmark or whatever benchmark we have set or below its averages. That would become reasonable price earning to enter into the company. Petronet LNG quoting at around 11 times its earning, and the cheapest in terms of valuations is GAIL at 7.8 compared to its 5 and 3 years averages. Price to cash for GAIL is 5 times, and we want this to be lower than the earnings, which would then signify that the company is receiving more cash than the profits it is declaring or the earnings it is declaring. So this is what it is reflecting. The price earning and price cash is reflecting exactly what PAT annual and cash flow from operations mean. Petronet LNG's price to cash is 15 times and it is above its price earning. In fact, Indraprastha's price to cash is the highest at 27 times. So we are getting it very expensive here. In terms of price to book, GAIL is trading at a discount to its net worth. People or investors in the market don't see or don't seem to believe that the company is worth what it is quoting in its books, and therefore discounted it in terms of price or market price. Petronet has seen a 3 times price to book valuations. Most expensive is Indraprastha at 7 times its net worth. So I would definitely not buy into this because it's very expensive, at least in valuation terms. It may be a good company, maybe generating a very high returns, but yet I would wait patiently for it to fall. Then I'll consider if I want to buy into this. Indraprastha also has a high price to book, so I would even avoid this for time being unless and until it is very tempting on a technical basis. Price earnings to profit growth rate or PEG ratio of 5 and 3 years for all the three companies, at least for GAIL and Petronet, it seems it's below 1 times, which is a good value. This considers the price earning that we are paying 7.8 times for GAIL. Against that, what is the growth in profits that you are getting? So even if we consider 8.4% of growth rate and ignore this 40%, because what has happened, as I already explained in the profit and loss account, when we look at from 3 years back and from 5 years back, we see a drop from 5 years back to, that is from 14 to 16, we see a drop in the overall profits, and then it has increased again. So we have to ignore this 40% unless and until this is lower than the 5 years data, then we can consider the lower one, but we can consider any of these two provided they are nearby each other. We don't want a very high variation between the 5 years growth rate and 3 years growth rate. So as I explained in my earlier videos also, when we see a growth rate in sales or profits in terms of 5 and 3 years at a very high percentage terms, then we have to look at the individual values, because that will give us a true indicator. Percentage will mislead if the values that we are comparing to create the percentage has a huge gap in them. So here at least 8% even if we consider for the last 5 years profit growth, and we are paying a price to earnings of 7.8, so we get a PG of approximately 0.9. There is no unit associated with it because price earning is in times and profit is calculated in percentage, so we don't get a unit in this, so we just say 0.9 PEG, and it should be below 1 or 1.5. My benchmark is 1.5, but many investors prefer PEG to be below 1 times before they can consider buying into this company. Petronet also is quoting at a good valuation of 0.4. Even if we catch the lower of the two in terms of profits growth at 25%, we're just paying 11 times price earning, and in that earnings we are getting a growth of 25%. Indraprastha 3 years PEG is better, 5 years PEG is a little higher. We are paying 28 times the earnings and we are getting a growth of just 15% in that earnings over the last 5 years. So this is little bit expensive. In terms of sales growth over 5 and 3 years period, all the three companies are still in positive growth rate. GAIL India has grown its profits at the rate of 5.5%. So the lower of the two we'll consider for our analysis. Petronet is growing at 0.3% and Indraprastha at 8%. So all these three companies are growing their revenues through sales at below 10%. In terms of return on equity, all the three companies seems to have generated around 15% and above profits for the shareholders. And if you look at the 5 years average, GAIL India's ROE percentage was little lower than the other two companies which were generating around 20% and above. Whereas even in last 3 years if we see, GAIL India's return generation on shareholders' money was lower than the other two companies. Return on capital employed for 2019 were higher for all three companies, about 20%. But when we look at the averages of the last 5 years, that stabilizes these values, and we get a better view when we look from a little far away at the 5 year and 3 year picture. GAIL India has generated around 15 and 17%, Petronet around 24-28, and Indraprastha at 30%. When we analyze the company's profile, there we saw that due to economic slowdown and also due to their contract through HH terminal, Henry Hub terminal, they were getting the gas or LNG at a higher price compared to Brent crude index. So there it is causing them a little bit problem, but we also saw that they were employing hedging techniques to overcome this high cost of LNG. Return on assets were almost double digit for 2019 or the recent 12 months for all the three companies. ROA percentage for 5 years, if you look, the lowest was GAIL at 8.8%. Again, we have to understand that GAIL is quite big compared to the other two companies and therefore would naturally have a higher asset base and growing at a much faster pace compared to the other two companies. But we'll have to analyze those other two companies separately to understand how they are growing. In terms of asset turnover, how many assets the company owned and against that how much sales they were doing, the highest turnover of assets into sales was by Petronet at 3.5, followed by GAIL at 1.6. This measures how efficiently the company is generating sales on its total assets. Inventory turnover for GAIL was little lower compared to Petronet and Indraprastha, but we have to look at how it was converting its inventory into sales 3 years back. So from 3 years back, both Petronet, Indraprastha and GAIL have increased their turnover. That is, they are generating now much higher sales compared to how much inventory they are holding in their balance sheet, and therefore it shows efficiency in terms of converting inventory into sales. As we earlier saw, asset turnover, which means that how efficiently the company is generating sales on its asset holding. Now we'll move on and look at the 5-year picture of the profits, cash flows and free cash flows. So when I'm doing this analysis, what I'm divided this into is short-term picture, a medium term, that is 1 year, and a long-term picture of 5 and 3 years. and therefore we get a complete overview of the company's working through the years as well as what is happening currently in the company. And we also get to understand different metrics in terms of profitability, valuation, growth, cash flow analysis, liquidity ratios, and so on. And through this we'll analyze and understand how the company is working and what is the health of the company. Based on that, we can make our decision whether we want to buy or let it go. Five years profits were 19,000 crores by GAIL compared to Petronet at 7,600, followed by Indraprastha at 2,800. So here we can see in the last 5 years, GAIL has given profits or generated profits almost double of Petronet. So we can again estimate the size of GAIL to be almost twice of Petronet. In terms of cash coming in through operating activity for the last 5 years, GAIL has generated around 28,000 crores of cash against the profit of 19,000. So this is a good value. We want the cash through operating activity to be more or at least equal to the profit after tax. Even Petronet and Indraprastha have generated higher cash than their profits declared. Free cash flow for GAIL was 14,000 crores, which signifies that the balance between 28 and 14,000, almost 14,000, that is almost 50%. 14 into 2 is 28. So almost 14,000 crores out of this 28,000 was put to buy or invested to buy fixed assets for the company or to incur capital expenditure or of capital nature. And the balance of 14,000 can be utilized in the financing activity, which would involve your bonus or repayment of loans or declaring dividend, etc. Petronet's free cash flow is around 8,700 and Indraprastha at 2,400 out of the 4,300. So almost all the companies are doing decently in terms of cash flow analysis. On an average basis, we can see that GAIL has earned around 3,900 crores every year since last 5 years on average, whereas Petronet at 1,500 crores and Indraprastha at 562. GAIL is currently available in the market at 39,000 crores, Petronet at 33 and Indraprastha at 32. Earlier we saw that Indraprastha's price to book was very expensive at somewhere around 7 or 8 times, which is very high, and therefore we can see this in this particular ratio that its net worth of 2019 was just 4,500 crores. Against that, company is valued at 32,000 crores. So we need to understand why investors in the market are giving it such a high premium valuation. Petronet's net worth is around 10,000, so again a 3 times multiple, whereas GAIL is going at a discount to its net worth. Its market cap is below its net worth. Checking out the contingent liability position, that is those liabilities which may or may not arise in the future and for which the company has not made any provisions in its balance sheet or P&L account, and therefore this liability can arise in the future, and we need to take this into consideration when we are doing analysis of the company, as this can have adverse effect on the company's profitability going ahead in the future. We also need to see what kind of contingent liability, if it's high, what kind of contingent liability this company is carrying. Is it high risk, low risk, and so on. GAIL India's net worth was 45,000 crores. Against that, its contingent liability is at 3,800, which roughly translates to less than 10%. Petronet again at a less than 10% of contingent liability. Indraprastha's contingent liability is almost 50% of its net worth, and therefore I would want to avoid in companies whose contingent liability position is going more than 20% of its net worth, and therefore it becomes a risk. But as I mentioned, we can go into the balance sheet or we can go into the footnotes section below the balance sheet and look at the contingent liability position, what kind of contingent liability this company is carrying. All the three companies are almost debt free and therefore would have higher coverage ratio. Even then, Petronet's coverage is way too low than the other two companies, although it is almost debt free. So this needs to be understood. Although I'm analyzing GAIL for this video, will not go into the detail of Petronet. Checking out the position in terms of promoter holding, all the three companies seems to have higher promoter holding in their individual companies. GAIL India is mostly government controlled, and I'm not sure about Petronet and Indraprastha whether it's private or government owned. So that needs to be checked separately. There is no pledge of any of their promoters. The companies are collecting their payment from customers very efficiently, and for GAIL in 2019 the debtors were just 6.6% of the total sales. Even for Petronet and Indraprastha it was very less. In terms of collection from customers, it is less than 20 days for all the three companies, very efficiently collecting and very quickly collecting payment from their customers. NPM margin for GAIL stood at 8% in 2019 compared to Petronet at 5.6, followed by Indraprastha at 13, highest in the group. In terms of dividend yield, because the price of GAIL has fallen substantially, as we saw earlier, almost 52% from its 52-week high, and therefore at current price, if someone buys and if the company keeps giving out the same amount of dividend which it paid last year, compared to that, then we can expect a 7.2% return, even higher than the bank's fixed deposit. If someone wants to do pure dividend play, then they can opt for this company, but keeping in mind that the company should be consistently giving the same amount of dividend which it provided in the earlier year. Petronet LNG at 2.45 is reasonable, and Indraprastha very low at 0.5. So this concludes my analysis of the peer group comparison of GAIL with Petronet and Indraprastha. Let's move on and look at the graph and see where the prices are currently and what is the RSI level through which, based on which we can decide our buying and selling levels along with the support and resistance lines. Let us continue with our analysis of GAIL's graph or chart program. We have a weekly chart, and my indicator for analysis and buying purpose is the relative strength index and the support and resistance lines. I would buy as usual when both the lines of RSI fall below 30 and sell if it goes above 70. Or even for selling purpose, I may decide if it's moving up very quickly, then I may not even sell it above 70, and then I'll maybe refer to the intrinsic value, or maybe I'll take my own decision for selling purpose. But as of now, for buying purpose, I would follow the RSI falling below 30. That is the double dip, as I call that. I would buy when both the RSI line falls below 30. If the fundamental of the company is not very good and I still want to buy that company, then I will wait for the double dip. If the company fundamentals are very good, return ratios are very good, then I would buy even at a single dip, that is the red line falling below line 30. My buying started in July 19. That is when the RSI first came below a single dip. The buying price to start was at 132 rupees here on this line, and based on this I had drawn support and resistance lines for my future buying. If the prices do fall, then I would buy at those price point. Then my next support level or resistance level was 118 after 132, so I bought here. Then the next one is at 103, 90 rupees, 78 rupees, 65 rupees, and then 55 rupees. I have a lower level of 46 as well, but we'll need to check if and when it comes at below 55 and 46 rupees, then we can think of entering into this company. Again, the RSI had come on 13th March 2020, and the price at that time was 84 rupees. So here too there was a buy. The buying should have been started at 78. So these are my averages. Now I understand that when I started buying it was very high at 132, but I don't have an option to see what is going to happen into this company. I trust the RSI in a certain manner that it will allow me to start buying at a lower end. The highest price that reached was around 199 rupees, almost 200 rupees, and from there it has fallen to 132. That was a substantial drop according to me, and from there on we don't have to buy everything starting at that price point, so we can spread out our buying in different levels or at different levels and accordingly buy. Nobody can time, including me, nobody can time the market exactly. We can buy in a gradual manner because we don't know how much the price can go down or how much it can fall. So we have to anticipate that and create different levels of buying. We may miss out the lower levels, but it's okay. At least we are not investing at a higher price and we are not getting stuck at a higher price. If we buy everything at the top, then we won't have any money left to buy at lower ends. So better to let it go and even buy a little higher, but not to buy everything at one price point. Also, till the time that you don't get opportunity to buy this company at a lower price points, you can invest it somewhere else, where in a very good company or in fixed deposits where it will keep earning you interest, or invest in a very good company, reputed company, even at a higher price point, so that you don't stand to lose a lot of money from there. And whenever the price falls for GAIL, you can always buy here. So I had total levels starting from 132. I'll read out the values that if someone is interested to buy accordingly, they can decide if these levels are good for them. 132, 118, 103, 90, 78, 65, 55 and 46. These are not my recommendations. This is what I will be buying at these levels. My buying has already got completed till 65, and next would be 55 and 46 if it does come down. Here currently when I'm analyzing, it's 9th April and the price has gone up to 87.75 rupees. Now from next time onwards, if someone is interested, they can check out the discussion tab of our YouTube channel, and there I will give my levels as and when the company values come below RSI on a daily basis or on a weekly at the end of the week, so that when I analyze, by the time I analyze and by the time I release the video, the prices would have gone up and therefore many people would lose buying opportunity. But only buy if you are 100% sure that you are comfortable with this company and you understand what this company does, what is its financial position, so that you are not tensed all the time that you have made a decision based on my saying or by looking at my video you have decided. Don't do that. Instead, you understand the working, what I'm explaining, try to understand that and take a decision of yours based on your understanding. You should be assured that what you have heard and what I have shown you, that makes sense, and therefore you should be in a comfortable position. You should not lose your sleep over prices moving up and down. You should buy company, not its shares. So to conclude here, the current price is 87 rupees, and if it goes up to 90, if someone has missed out, they can always buy. I bought at 90 around 5 weeks back. So even if today someone buys, they're getting it almost 5 weeks of time, ideal time, and you're investing late. So you can go all the way till 132 even if you want to buy, to average it out. I would even go up till 132. Either you start here or you can start early. See, I got stuck from August 19 onwards. Had I not bought here and I would have waited and then bought as it goes up, then that would have been much better for me. But I don't want to be greedy or be fearful in terms of missing the bus or not missing the bus, as they say. So not to complicate things, it is very simple. You keep buying on the support and resistance level. Try to make your average as low as possible, so that when the price turns back, you stand to gain faster, because your average price is very near to the current price, and therefore from here on you can gain much faster. If someone wants to buy, they can go all the way up till 132 and go all the way down till 55 rupees or At the lower end they can go up till 46 rupees. So we have total 8 levels, and accordingly, if someone wants to invest, they can break up their investment amount in this company, decide in advance how much you want to invest maximum into this company, and spread out your investment over this duration. As I mentioned, you don't need to buy every day, every week, every month. You can spread it out. Whenever you see an opportunity, you can invest at that time. So now let's move on and look at the intrinsic price based on fundamental growth of the profits, sales, ROE, balance sheet and cash flow from operations over the period of 5 and 3 years, and project it over the price. Looking at the intrinsic price calculation, I have 4 levels, 2 on the sell side and 2 on the buy side. There would be some discrepancies between what I am calculating in intrinsic price and what I see or what my levels are as per technical. There would be variations, but we have to take it with a pinch of salt that there would be differences, because here I'm projecting over the price the growth in the different variables that I explained earlier. Whereas when I'm analyzing the chart, I'm looking at the actual levels where the support and resistance lines can be put, and therefore that is more practical than the projection, because projections can mislead because that is of the past. And my understanding here, if I have to just explain the intrinsic price as it is, then I have 4 levels, 2 to sell and 2 to buy. We have to sell as it reaches 182 and 254. My projection is that the price would reach around this levels by 2021, and we can buy below 177 and 92. So whichever is the lowest level, we can consider that to buy into the company. Or we can integrate this intrinsic price values and check out the technical chart and see where the technical is telling us to enter and where the fundamental is telling us to enter, and therefore integrate both of them to understand what is the optimal level that we can start buying, because that is the most crucial point. After understanding the entire company fundamental, the next important thing to do is to understand where to buy, how to buy and how much to buy. Here we are using the projection of growths in different variables over the price. So if we calculate the average of all these 4 intrinsic targets that I expect it to reach, then we get an average of 176 rupees, and the current price is 87. So from 87 rupees to 176 is a 100% gain. So we can at least expect an 100% gain from the current price to the average of the 4 targets. And if from the current price it reaches the intrinsic price of 92, which we started buying, we can expect around a 5.2% gain. I don't play for such a small gain percentage, so we'll ignore this. At 177 you can expect around 102%, 182 around 108%, and a price of 254 almost double at 190%. So these are my projections. Now this may be or may not be true. It may or may not come, nobody knows, including me. These are just my projections. So this concludes my analysis of GAIL India. I have done a detailed analysis. I request you to watch the entire video and thoroughly understand how to analyze a company once and for all, and then if you feel comfortable with the understanding you got from this video, then you can take your own call of whether to buy or leave it aside. So this concludes my analysis of this video of GAIL India. Thank you for watching. Stay safe.